So Calvart Home Mortgage Investment Corporation is just that, a mortgage investment corporation. We are based out of Calgary, Alberta, and we lend throughout Alberta and Ontario. We have a few things that make us unique in the mortgage investment corporation space. The biggest thing is our focus. We focus on short-term residential lending in major urban centers. And when I say short-term, you can basically classify it by saying we want to be in and out of a loan within a year. We want to support Canadians who need short-term residential lending that they're going to pay us out within a year. And that payout can be through refinance or through sale. And a very specific thing that we focus on is supporting real estate investors with short-term capital. So real estate investors are either buy, renovate, and sell, flippers, or they buy, renovate, rent, and refinance. So they're buying, underperforming residential real estate. Usually it's 16 units and under. They are renovating them. They are stabilizing the income, and then they're going to the banks for a refinance. And that's about 70% of what we do. Again, and we're doing that because we saw a big void in the market. 30 years ago, our founder and still the chairman of our board was working with real estate investors in and around Calgary and realized that really the banks weren't supporting them. Like it's too short term. A lot of times the properties they're buying are in such need of repair that they don't qualify when an underwriter looks at them. And we're there to support them. And what we're seeing here in Canada is that Canadians very much have a desire to own single family residential property in major urban centers. There's simply not enough supply of them. And our borrowers are going there identifying properties that the general market doesn't want. Like they're hoarder houses, they're houses that haven't been renovated in 40 plus years. They're houses that your average buyer doesn't want. They're going in and they're creating housing stock out of underperforming housing stock. Sometimes they're just doing door for door. Sometimes they're building, they're suiting them. They're building laneway suites. They're in a lot of instances creating additional supply with that. So that's essentially what we do from the lending side.
Gotcha.
That makes us very unique.
Okay. And so out of curiosity, do you also work with builders? Like they come in, they buy, they tear down, and then they go vertical? Or is that not, because that time frame would be more like 18 to 24 months generally, right? So I'm curious, do you have a program for that, or is that not really your target?
It's a good question. If you were to talk to me 3 years ago, my tune would definitely be different. So 3 years ago, we had on average 15% of our portfolio lending to pure construction projects. We've gotten out of that since. Today, it's about 2%.
Okay.
And for a few reasons, like when we look at the total available market for where we're really unique and supporting, which is those real estate investors. In order for us to properly serve them, we have to have really good focus on that. And when we do go out to construction, it's a different loan product. It's a different type of risk. It's a different type of underwriting. We need different type of capital partners. So for those reasons, we're focused particularly on lending to real estate investors who are not tearing it down. Typically, they're doing, a $70,000 rehab, kitchen, paint, drywall, floors, and getting it back onto the market. So long story short, we are no longer focused on construction. We do the one-off, for a client that we've been dealing with for a long time, or just like those slam dunk loans. But because it's not our forte, typically when we're looking to do those loans, we were like, no, you don't want to borrow from Calvart. Here's who you should be borrowing from. Lenders who really have built out a construction program and who want that business.
Gotcha. Okay. That's good to know. And then so I'm just going to repeat a few things, not like, just hopefully it kind of lands if someone is kind of new to the world of MIC, so mortgage investment corporations. And so I want to, and this is for me, are you essentially a fund, meaning you will go out and raise a pool of money from investors. So multiple investors going into multiple properties. Is that typically how it goes? Or is it syndicated loans where it's five investors that come in and lend on a specific property, or both? Or I'm just kind of curious how that works.
Right, good question. Mortgage Investment Corporation, we are a fund. So we are one entity
Yeah.
in which all of our money, all of our income, and
Yeah.
we earn income through interest payments and fees go into that entity. All of the expenses get paid out of that entity,
Gotcha.
and all of our preferred shareholders are within that fund. So right now, we are operating approximately $300 million.
Yeah.
Of that 300 million, 200 million is preferred shareholders or debenture holders, basically, and those are made up of high net worth individuals, family offices,
Gotcha.
and we have a couple discretionary fund managers. And then the other 100 million is we have a great bank facility that we borrow at prime plus 0.5 on, and we're able to leverage up the return to our shareholders through that facility. So it's all
Oh,
one
interesting.
entity. Yeah, it's all one entity. The readers of our financials get to see everything going into the fund and coming out of the fund.
Yeah.
And what makes us unique is typically in the mixed space, you'll have your fund and your fund manager,
Mm-hmm.
where the fund manager is charging 1 or 2% to manage the fund, and
Yes.
they're also earning fees that the that will come from the lending activity.
Right.
Uh, Whereas with us, we don't have that. It's one entity. So typically, our shareholders really value that because there's more transparency. There's no black box. But more importantly, me and my partners within the fund, we're not getting wealthy risk free of the fund. We are fully invested in the current financial success and the future financial success of Calvart Home Mortgage.
Yeah, and that was actually one of the questions that I asked you when we first started, which was like, are you essentially doing both sides, right? You're raising the money and you're actually doing the lending. And I think that that is a really important point because your success is tied to both activities, right? And you're only going to be as good as the type of loans that you're lending on, right? I mean, if because I've seen this world where there are, like, let's face it, it's usually secondary mezzanine bridge financing, shorter term, perceived higher risk. And I say perceived because frankly, when you really understand a market, you know what the value is, right? And maybe
Yeah.
we can talk a little bit about that in terms of, like, let's say I come to you and I say, Jesse, I found this property, it needs some work. What kind of loan to value, like how do you evaluate how much you will lend, both on the property and then both on the borrower as well? What kind of covenant are you looking for? I think that's important to give both sides of the equation.
Yeah, no, and it's critical. And going back to what makes us successful is managing risk.
Yeah.
And the best way the best way to manage risk is through our underwriting.
Mm-hmm.
And that's what's made us successful the past 40 years. And that's what will make us successful the next 40. So if we're doing good business and we're lending out money well, we're getting it back, we're protecting our principal, and we're providing a good risk adjusted return, the capital is always going to be there. It will come. But the minute we are not focused on managing that risk, that's when it's going to be hard to raise capital or we can't grow or whatever. So going back to your question, Shane, which is basically how do we evaluate risk when a real estate investor comes to borrow from us?
Mm-hmm.
And the way we do that is multiple fold, but I'll start with kind of the most simplistic thing we do. The most simplistic thing we do is we look at the property value that they're purchasing it for.
Yeah.
We look to them to understand what their budget is going to be. Then we value the property after repaired, after renovated.
Yeah.
And we have a ton of expertise in that area. We hire appraisers, designated appraisers, who work for us internally.
Mm-hmm.
The reason we do that is multiple fold, but really we love to have the data and we love to know our numbers.
I was just going to say that. As soon as you said in-house appraisers, I thought that is so smart because the reality is in the world of real estate, and I hire appraisers and I love them. But the reality is you, as the person that's paying the fee to the appraiser, has and can influence the outcome of that number. Like, let's just call a spade, right? The reality
100%.
is that because otherwise, and that's why in the US it's quite different. The banks actually hire the appraisers and they will charge me, the borrower, but I don't see that as much, at least on the commercial side. On the residential side, I think a lot of banks will hire the appraisers and whatnot, but having it in-house just takes it one step further. And so I didn't know that, and I think that I just really wanted to emphasize the importance of and value of that. So sorry, I didn't mean to interrupt.
Yeah, no. I love that you appreciate that, because it's so important to the success of our business. And never mind, because of the uniqueness of saying, hey, appraiser, value this after repaired. Good luck trying to find your classically trained AACI appraiser to do that, because that's a very unique request.
Yes.
And anytime you're looking at a unique request, they don't have the expertise in it, and it's harder for them to do that work. Whereas with us, we are literally valuing billions of dollars of this. We understand it. We have the consistent feedback loop, because these properties are typically paying us out within 6 to 9 months. So we can go back and say, was our valuator correct? How far off? What did we miss? What are the trends we're looking at? So that, like you said, that's a huge value add, but also it's a value add because now we're saving our borrowers money. We're not having them pay $500 for an appraisal, but more importantly, we're saving them time. A lot of our borrowers, the real estate investor, they're being successful by buying right? Like, they're not successful because they're doing their renovations at 10% less than the next guy. It's all about getting the property under contract at the right number. And a lot of times they're able to do that by providing a solution to the borrower. Sorry, a solution to the seller.
Yeah.
The seller, again, may have financial issues, may have they need to get out. They're too old to continue to maintain the property, whatever it may be. Usually it's they need to sell the house. And by our borrower going in and saying, yeah, I can take this off your hands. What time frame works, whether it's 4 days or 4 months, being able to provide that flexibility is huge in enabling them to get the discount they need to be successful. So for those reasons, in-house valuations are awesome and work for us. And really, it's all about managing risk. So going back to your question on how do we underwrite these things, it's okay. We understand what the property is going to be worth after it's renovated. We understand their costs.
Let's use real numbers just as an example, because I think people will. So let's say I come to you and I say, I found this house. I could buy it for 400 grand. It's going to cost me, just let's use real round numbers. It's going to cost me 100 to fix it.
Yep.
What would the after repair value be for you to say, you know what, that's a good deal?
The after repair value for me to say it's a good deal is them making money, and them making real money. I don't want to see our borrowers buying a job. Yeah. So like for this example, where they're going to have a capital outlay of, call it 500 grand.
Yeah.
I'll want to see them, and $100,000 is a relatively larger budget. Yeah. So I'm going to say that's going to take at least 2 to 3 months to renovate.
Yeah.
Call it a month on the market, a month to take possession. So a 5-month project. And I'm ballparking here. Yeah. But I would say the entrepreneurial lift, you're going to want to see them making at least 50. And when I say 50, I mean net, like net after our fee.
Everything. Yeah.
Everything. And we provide to our borrowers, and the market as a whole, we provide to them our flip analyzer. And it gets as granular as literally them thinking through the insurance cost, your snow shoveling, if it's a winter flip, your electricity. Like, too often, real investors as a whole will miss, I didn't calculate realtor costs. Like, what? That's a massive expense. So we don't let them forget anything, and we look at what is their net. And for a project like that, I'd want to see them making at least 50. When I think about this project that you're outlining is perfect, because it's exactly what we do. Yeah. Mid to lower half of the market. They'd probably be selling that for around 615, based off of quick math in my head. And this is a vanilla cookie cutter project that our volume flippers would do 10 or more of in a year. But even our non-volume flippers, like the trades who are doing one off a year to help supplement their income,
Yeah.
this is a perfect flip for them, where now they're earning themselves another 50 grand, and it would be kind of the same effort as them actually going out and doing the work, but they would make maybe 15 grand if they were being employed by someone.
Yeah. Okay. So I'm asking this for a couple different reasons. One, my brother is a realtor, and I think that he's kind of explored the idea, because this is how I cut my teeth, right? In 03, 04, I flipped homes. That's how I got into the business of real estate investing. And now I've kind of, moved up the chain, if you will. But I think it's a good place to start, because it gives you a real sensitivity on location, on borrowing, on understanding markets, on the things that can go wrong. And let's face it, real estate investing can be, there is risk, and you can definitely lose if you don't have the right approach and strategy. So one of the things I wanted to ask you specifically on this is, what are you looking for from the borrower? Are you looking for like credit worthiness? Are you looking for covenant? What kind of leverage could they expect? Because I think that that'll be an important question for someone that's coming to you as well, right? Like,
Yeah,
how does that look?
it is. It is. Firstly, it is flipping is a great place to start. And it's because of the barriers to entry. Like, you can get in with relatively low capital and low experience. And that's something we're happy to guide our clients through. So ideally, Shane, like we have a borrower who has good credit, who has a decent amount of capital. Like in your $400,000 example, I'd want to see them coming to the table with 150 grand.
Okay.
Actually, no, more than that, because they're going to have to service our debt. Call it 170, give or take.
Okay.
I'd love to for them to see them have some experience. Like maybe they're a trade, maybe they're a realtor, so they can add value to the project.
Yeah.
That's where we would love. Now, that's not to say we won't work with people without the experience. Like, there's a lot of young or even old entrepreneurial people who are getting into this, who have really thought through their analysis, who have thought through the variables, who know their numbers, and we want to support them.
Yeah.
So what I want our borrowers to do is basically convince us that we should be partnering with you.
Yeah.
And the way that you convince us is when we're talking with you, you know your comparables, you know your numbers. If you're not a trade, you know who you're going to use for a trade. Not only do you know who you're going to use for a trade, but you know how to audit their budget. like, oh yeah, drywall does cost this much. It kind of you've quoted it out, or sorry, you 3 quote 1 buy type of deal, where you're owning the process. Yeah. What scares me is when you get a person watch too much HGTV, called the realtor. Oh yeah, I can find you houses to flip. Realtor has no incentive other than to sell you properties. Yeah. Trade has no incentive other than to win the contract. And those are not going to be money-making endeavors. So having that entrepreneurial spirit, knowing your numbers, ideally you're having a value add component, whether it be, again, expertise within the real estate industry or expertise within the trade. On the credit side, credit worthiness, like credit score, yeah. We don't get too fussed about. Our minimum is 500, our minimum beacon. We're lucky that most of our borrowers are professional real estate investors and they treat their credit really well. So for instance, right now, 78% of our borrowers have a credit score of at least 650. Which is almost bank level. Like if you were to look at, the MIC competitive landscape, yes, they're going to be a lot lower. And going back to, we don't look at gross debt service or total debt service the way the banks would for these, because we're looking at them through the lens of, this is an individual business opportunity. Yeah. Do you, let's say what's your brother's name, Shane?
Mark.
So Mark's looking at this one. He's buying it for 400. His renovations is 100. Let's say carrying costs for us is going to be 30K.
Yeah.
So Mark, do you have 130? Yeah. Okay. Let's see the money. Credit, line of credit. Shoot, Shane could be a joint venture partner with him. Show us that you have the money.
Yeah.
And we will lend Mark, as long as he's going to make money, we will lend him with as little as $20,000 down on this project. So we will lend him 308. Sorry, if it's Calgary, we'll lend him with as little as 10 grand down. As long as he's making money and we trust him with our money, we will lend him 390 plus fees.
Interesting. Okay.
Yeah.
So really what the equity that they bring to the table is for the renovations, essentially. Is that the
For the renovations, but they're also buying right? Like
yeah. No.
usually they're not buying on market.
Yeah.
So they're buying through a wholesaler. Mark's gone out and done some door knocking.
Yeah.
He found this deal where he's getting a good value. So
Yeah.
that really protects our risk is on the purchase.
For sure.
And by running our numbers backwards and ensuring there's profitability, that usually tells us right away they're buying right.
Yeah. Okay. Okay. This has been okay. So that kind of talks about like the business component. Now I just kind of want to switch gears to an investor coming to you saying, Calvart Homes, I want to put some money in with you guys. If I'm getting too nuanced or specific, just let me know. But what's kind of a minimum investor requirement? Like accredited, do they come in with 150, 250, 500? Like you said, family offices and you know, like I was kind of thinking you're dealing with some obviously more institutional almost investors, but what would be more of a high net worth investor that would be coming to you and putting money in, just so I have some goalposts.
Yeah, so the minimum standard that we have is
Yeah.
accredited.
Yeah.
So you have to either, for your audience, just quick review, essentially you have to either have $1 million net financial assets, or earn as an individual over 200 grand, or as a family unit 300 grand.
Okay.
And if you meet that, then you could look to invest with us.
Mm-hmm.
We don't have a minimum per se, because usually an accredited investor typically isn't looking to invest less than 50 grand.
Yeah.
Um, Strategically, what we've done as a company is look for the more sophisticated, really high net worth individual, family office, or in portfolio manager.
Yeah.
And the reason for that is we have plans for significant growth. We see the opportunity to continue to serve Canadians, borrowers, to again create housing stock out of what is essentially nothing. And Canadian single family housing stock is significantly undersupplied. So we think we can go from today, which is lending about 360 million a year, to lending $1 billion a year within the next 5 years.
Nice.
And in order to do that, we're going to need to bring on shareholders.
Yeah.
And the shareholders we want to bring on are the family offices, the really high net worth individuals. But that's not to say we're not interested in taking accredited investors' money. It's just not a focus of ours. So if an accredited investor calls and they're looking to put in, let's say, 100 grand, we're going to take that call. We're going to treat them just the way we would treat the family office investor, because what we've seen over our history is if you treat any person right, who knows who they know? Who knows where that introduction, that relationship can go?
Yeah.
So I don't want to say a lost leader, but we're absolutely going to look to support that investor and bring on their capital. Again, it's the focus has gone away from that investor to more, an average investment size of closer to $1 million plus.
Yeah.
Right now, we have 18% of our shareholders making up 80% of our loans, kind of that 80-20 rule. We anticipate that to continue, but we're out there, we're doing loans, we're working with realtors, we're working with lawyers, we're working with mortgage brokers. And it's always an honor when they call and say, hey, Calvart, you guys do some amazing work. I'd like to learn more about investing. And we absolutely want to take care of that capital the same we would any capital. So long story short is we're seeking a larger average investment than we had been 3 years ago. But we're okay to take any investment as long as you're accredited.
And I'm not going to put words in your mouth, but me as someone that has raised money for my own projects, and this is something I've noticed with a few of my investors, and I'll use Jim as a good example. Like they appreciate deal flow. Individuals that have invested in real estate, they want to see the best deals, they want to be exposed, they want to be in those opportunities, and they will make my life as someone that's going out, because they know that 90% of my time should be focused on finding great opportunities and executing on them. It should not be investor relations. And that's not to say that that role is not important. It very much is. But I can just tell you in my own experience, if you're having to talk to someone that invested $50,000 in your deal every friggin' week and explain to them, like, real estate is illiquid and it takes a long time, generally speaking, especially on some of my projects. So for someone that is looking at investing, just think about it and say, like, I'm not suggesting that you roll over or not ask the appropriate questions. I think that that is very important. But if you become problematic for someone that is in your space, hey, am I going to spend an hour on the phone with someone that could write $1 million check or a $50,000 check? I mean, it's just, we only have so much time in the day. And so I think that I just want to kind of emphasize that. I hope it doesn't come across as being like too much of a prick, but that's just, like the world that we live in, right? We have so much time, and I don't know if you want to touch on that at all, but
Well, along those lines, this tip is a really good reason why we want to go after the more sophisticated investor. And I don't want to say your net worth has a direct correlation to your level of sophistication, because that's not necessarily the case. But typically these people writing larger checks, and more importantly, when we have a lower percentage of their net worth,
yeah.
then they understand it. Like, they're reading our quarterly financials, which we provide a ton of really great transparent disclosure. Maybe every now and then we're calling to do a quarterly or biannual update type of deal. But it's just that, like as long as we're performing within, I'll call it the risk in which we've educated you on. Like, what we're telling our shareholders today is, here's the rates and fees in which we're lending money out. Here's the loan to values in which we're lending out. Here's the locations. Here's how the market's going. And we're doing a good job if you're seeing a return of between 8 to 10% annually.
Okay.
If our book is at or below 65% loan to value, if our average credit score, if the 650 minimum is at least 50% of our book, if 80% of our money is in large urban centers. So we're doing a good job of that. So they're reviewing our audited financials and checking those boxes. And kind of those are the relationships we want to build, like being really clear on, here's what Calvart expects to do, here's what you should expect in return. And if we're below 8%, there's going to be really good dialogue within our management discussion and analysis. If we're above 10, give me a shout out one day, but don't expect it. So kind of good fences builds good neighbors is my thinking there. And again, just being really transparent in what we are and what we do, and what they're putting their money into.
Okay, so one, I'm glad you touched on what kind of returns an investor could expect, because that was a question I was going to ask. With interest rates rising right now, I have some commercial projects right now where it's our loans are based on prime. Well, prime is between 6.7 and 7.25 with a lot of these banks, and if they put 50 to a 1% base, 1% spread, I'm approaching 8%, and that's from a tier one bank. And so, so this is my question. Have you started to creep up your lending rates, just given the fact that if a person can go get 5% the equivalent of a T-bill or a bond,
A GIC, yes.
A GIC, do they say 8%, that's enough, or are you kind of starting to have to push those rates up to keep people motivated, if you will?
Well, based off of our, again, when you look at the composition of our book, keep in mind, we haven't really provided an 8% return. Our 5-year average is it's around 10.71, and our tenure is just under 10,
Okay.
9 and something.
Gotcha.
Um, but going back to that 8, like if our portfolio is composition in a way that it's really low risk,
Yeah.
then absolutely sophisticated money would still look to park capital with us, because that is still quite a spread versus your GIC.
Yeah.
Although we're always considering what are the alternatives, how can we get better, and to us better is basically how can we reduce our risk
Yes.
and provide a better rate of return.
Yeah.
And sometimes you can do that, like I talked about, how we have bank leverage.
Yeah.
Bank leverage increases our return, and to me reduces our risk, because now we have a really sophisticated third party who's partnering with us, looking at our lending standards, how we're doing those loans, auditing that, we're reporting to them on a monthly basis. It's just making us as an organization better. So we always have to consider what are the alternatives. We always have to consider what is our risk profile, and we're always working with our shareholders, especially the family offices and the portfolio managers, because they're really in tune with alternatives to make sure that we're meeting their expectations. So going back to the spread that we've seen, where rates have gone, we're in an increasing interest rate environment. Our shareholders, based off of the composition of our book and what we're going to return, which is this year it'll be somewhere around 10.5%. They're really happy with that.
Yeah. You've said this twice, and I want to just kind of go a little deeper if you're okay, because I have considered starting a fund for my own investments and whatnot, and there's a lot of benefits to having a fund. The one drawback for me has always been having capital that is not deployed, because then that pulls down your returns. And so this is a question because of what I've heard on this, on the fact that you have bank financing of about $100 million, right? Is that does that give you the opportunity to be kind of like fully deployed and not having to, like having a fund fully deployed is no easy task, especially when you have so much churn, right, on an annual basis. Yeah. So does that give you that elasticity to kind of, ratchet up and down where you're not having funds that are not deployed? I don't know if I'm asking the question right.
No. I think you are ensuring that funds are fully deployed is critical. Yeah. But what's worrisome too is sometimes if you're working too hard to deploy funds, you might be taking on risks that you shouldn't be. Yeah. So what's really what we love about operating the line, having that nice big operational line of credit, and by the way, that line of credit is approved up to 200 million. Okay. There's some covenants that restrict our availability to get all of that, but one thing it does is it doesn't motivate us to grow. It motivates us to be really efficient with our capital, and we're always fully deployed. Like right now, we're borrowing 100 mil. All of our shareholder money is fully deployed. Gotcha. And we're borrowing that 100 million from the bank. Because we have room to grow that, it also provides a value to our current shareholders in that I don't have to go out and raise new investor capital to grow the book. And what's cool about that from a shareholder perspective is our most expensive capital is the investor capital. So that's I'd rather, our current book of business would rather us borrow it. That's right. I think typically they would rather have us borrow it from the bank at today, which is prime plus 0.5 in and around, rather than go raise it from the new shareholder at, let's say a 10+% return. And I should state, I think it's important to state that, all the returns we're talking about, past returns have no indication of what future returns could be. And there's always risk associated with investing. I don't think maybe we could do a disclaimer ahead. Yeah, of this isn't investing advice, because we are getting into some numbers that we really should, again, back to transparency. We have an obligation to educate our audience that all these numbers we're throwing out are simply historical performance. They have nothing to do with what we hope to do in the future. Yeah. It's like, I know it should go without saying, but this isn't investing advice. This isn't legal advice. This is just two guys having a conversation, and you're getting to listen in on me really kind of go deep
on, because I understand this private world of lending, both as a borrower and as an investor. And so hopefully, depending on the who you are as someone that's maybe listening to this, you can kind of evaluate whether or not it makes sense to have a conversation with Jesse or another Mick, if you will. But at least you're seeing the type of questions that I ask, and hopefully it will give you some kind of goalposts in terms of like, oh, okay, I like the leverage. I like this about them. I like the type of borrowers they use, the type of assets that they're investing in. So I know we're kind of running up against the hour, so I want to make sure that people know where they can go and find more about you. I've been to your website. There's a lot of great resources on it. Where, if someone is interested, either as an investor or a borrower, where should they go?
So borrowing, certainly our website has amazing material. Same as our Instagram. We're one of our core tenants in really sales, business development is education.
Yeah.
So that's where the prospective borrowers, these are the flippers, these are the real estate investors, that's where they'll go to get information.
Yeah.
On the investing side, we've been blessed in that we don't have to do much, I'll call it hard selling. So you won't find any information on investing in us on the web. You'll contact me or our CEO and president, Dean Keller, or we have two other dealing representatives. We're regulated as an exempt market dealer. So there's Garrett Labar and Ryan Day. But really, the easiest way is just reach out to me by email, jesse@chmic.ca. Is easiest. My phone number is 403-617-9931 and have a discussion. Typically, the way it works is we would send you, a few years of audited financials. We would send you an investor package so you understand how we'd work together, rights and responsibilities. Make sure first that you are a good fit to work with us. But on the investor side, there's not really any public information. But we do have, again, a lot of really great disclosures, financial history, and financial statements that we can share with you if it makes sense to go down that road.
Perfect. I just want to give my own kind of 2 cents on that too, is that I want to kind of bring to your attention, if you're listening right now, that like Calvart Homes is not running seminars, spending $100,000 a month in newspaper ads to attract investors. That should be like, anytime I've seen that generally is a sign for me to go the opposite direction. And I say this because I have fallen victim to it, where you sit in the presentations. It's a very emotional, high pressure, short FOMO, where you got to put your money in today. Like, you just listen to the way that Jesse described how they talk to investors. They want to make it so that it is a very pragmatic, non-emotional, look at the numbers, look at this. I think that is just so valuable and important that I just wanted to point it out, because frankly, I just see too much of it, and I'm anti that. So anyways, Jesse, this has been great. I've enjoyed our conversation. I'm glad that Jim put us in touch, and although it took Ryan to finally get us connected. So anyways, any final words?
No, quick final words. I appreciate the thoughts, and I think that is at least how we operate, is let our business speak for itself. I don't have to do a hard sale pitch or have a bunch of flashy information. And sometimes the investment bankers and the portfolio managers want us to have more flash so they can sell it to their investment officers and that kind of stuff. But we're really focused on doing the right business, and in turn, we hope that we would be considered a solid investment option for people's hard-earned money. I really enjoyed the conversation. I think we could have a number of additional conversations about multiple other things, and I'm looking forward to doing that with you.
Wonderful.
Thanks to your listeners for, again, listening to us, and hopefully we provided them some value today.
Awesome. Well, thanks, Jesse, and I'm sure we'll have future rounds on the show in the not too distant future.
Brilliant.